startup just raised $500 million. The media hails it as the next unicorn. Employees are celebrating, investors are ecstatic, and everyone assumes it's destined for success. But here's the reality. Money alone can't guarantee victory. Nearly 90% of startups fail, even some with massive funding. Billions in the bank won't stop a company from collapsing if the strategy, execution, or market fit isn't right. So why do some startups soar while others fizzle out despite huge capital? Let's break it down. Let's break it down with a simple analogy. Think of funding as rocket fuel. It can make your startup shoot into orbit, but if the rocket is poorly designed, if the team isn't trained, or if the launch trajectory is off, it will crash spectacularly. That's exactly what happens to many overfunded startups. The promise and pressure of big funding. Big funding is every founder's dream. With millions in the bank, you can hire the best talent, launch massive marketing campaigns, and scale operations fast. Investors expect rapid growth, high market share, and huge returns. Take Juul, for example. The e-cigarette company raised nearly $13 billion over a few years. With that money, they expanded internationally, hired top talent, and marketed aggressively. But the pressure to maintain hypergrowth created regulatory and reputational risks, which slowed their trajectory. This shows the paradox of funding. It offers incredible opportunities, but also immense pressure. Founders are often pushed to prioritize growth over product-market fit or long-term sustainability. The double-edged sword of funding. Funding can be a double-edged sword. Startups with abundant capital sometimes scale before fully understanding the market, burn through cash faster than revenue grows, focus on growth metrics rather than real customer needs. Take WeWork. They raised over $10 billion, expanded aggressively worldwide, and reached a valuation of nearly $50 billion. But overexpansion and poor management pushed the company to the brink of collapse. Or consider Quibi, a short-form streaming platform. They raised $1.75 billion, had celebrity backing, but failed to resonate with viewers and shut down in just 6 months. Even Theranos, which raised $700 million, couldn't escape failure. Investors were dazzled by promises revolutionizing blood testing, but the product was unproven, and the rush to scale without validation led to one of Silicon Valley's biggest scandals. Here's a clear example to visualize it better. Imagine pouring gasoline into a car's engine. If the engine is well built, it goes fast and smoothly. But if the engine is faulty, the car will overheat or break down. Big funding is like gasoline. It can amplify success or disaster, depending on how you use it. Small funding, big success. Now contrast that with startups that succeeded with minimal funding. Take WhatsApp. They raised relatively little money early on. Instead of chasing flashy growth metrics, they focused on simplicity, reliability, and solving a real communication problem. That disciplined approach led to massive adoption and eventually a $19 billion acquisition by Facebook. Similarly, Basecamp, a project management tool, stayed bootstrapped for years. By focusing on customer needs and slow, steady growth, they built a sustainable business without burning investor money. And MailChimp started almost entirely self-funded, scaling carefully while keeping full control of the product. Today, it's a multi-billion-dollar company. Key lessons from data and anecdotes. So, what can we learn from these stories and the data? Funding is fuel, not the engine. Cash can accelerate growth, but execution drives success. Solve real problems. Don't chase valuations or investor hype. Focus on creating value. Sustainable growth beats flashy scaling. Rapid expansion without a strong foundation often leads to collapse. Team quality and disciplined strategy matter more than capital. Even the best ideas fail without proper execution. In short, funding can amplify success, but it can also amplify mistakes. It's a tool, not a guarantee. So next time you read about a startup raising hundreds of millions, remember this. Big funding helps, but it does not guarantee success. Focus, strategy, and execution matter far more than the size of the bank balance. Which startup do you think defied the odds? Which one collapsed despite billions in funding? Comment below. We'd love to hear your thoughts. And if you enjoy exploring startups, business strategies, and growth stories, hit like and subscribe. You won't want to miss the next deep dive into the world of entrepreneurship.